Hey, welcome back everybody to another episode of Cash Flow with JVH. Today we're going to be talking about the poor man's covered call. Just a reminder, please subscribe to this channel if you haven't already. Please give this video a big thumbs up and like some of our other videos, helps us get more exposure. If you're interested in helping support the channel, we would really appreciate it. We have our Robinhood referral link down in the description. We also have our Venmo account down in the description if you would like to contribute that way. And as always, please share these videos and our channel with your friends. Okay, so today we are going to talk about the poor man's covered call, which is the ability to buy a long call and then sell short calls against that call to protect your investment. If you're not familiar with the terminology and the concept of selling options on Robinhood, which is the platform we're going to be using in today's example, I would strongly recommend you take a look at our previous video series, which goes over all of the different aspects of buying and selling options. So I would recommend watching this video that I've put a link up at the top for, and check that out first. Okay, so first question you should ask yourself, if you don't already know, is what is a covered call? Now, we're going to talk about the poor man's covered call, but in order to talk about the poor man's covered call, we have to talk about what a covered call is. And a covered call is you're selling a call option against 100 shares of an underlying stock that you already own. So, for example, if you own 100 shares of any stock, right, any underlying stock, and you are basically gaining money, the idea behind a covered call is selling the option to selling an option, which is selling a call, so that you're selling the ability, not the obligation, the ability to sell those 100 shares that you already own to somebody for a higher strike price. So let's just give an example of that. Okay, so let's take an example. Let's say you own 100 shares of the stock AAPL, which is Apple. And let's say you bought those 100 shares for $50. So you have invested $5,000 into Apple. The idea is you own those shares. They can never expire. They're never going to go away, right? And as the stock goes up, maybe you want to start selling calls against those 100 shares in case the stock goes down, basically collecting the theta, collecting the premium. You could sell that call at, let's say, a strike price of $75. The current price is $60. And I'm making up these numbers. Obviously, I think Apple, as of right now, is like $130 a share. But just for demonstration purposes, I'm using these numbers. So you bought the 100 shares of Apple for $100. The current price is $60 a share. So you've already made, based on that current price, $1,000 on those shares. Okay, so now maybe you're thinking, well, possibly the price might start coming back down, so you want to try to protect that $1,000 profit that you've already made. So you can sell a covered call, right? And covered means that if for some reason they decide to exercise this call that you're selling, you already own the 100 shares to cover that call if they decide to exercise, and it'll take those 100 shares away from you. So you can sell a call, let's just say at the strike price of $75, you will instantly collect the premium of 30 cents per share. And since there's 100 shares in that contract, you have now collected $30 in premium. And the idea here, right, is you've collected that $30 in premium for selling this call. So now you have a total of $1,030 profit. And if this current stock price goes from $60 to maybe $55, you will have lost $500, but you'll have gained that $30 towards that $500 profit loss. So you're actually protecting your investment of those 100 shares by selling calls against them. Now you have to have 100 shares in order to sell a call against them, in order for it to be a covered call. There are scenarios where you can sell a call and you don't have anything or you're not covering that call with anything. That is extremely risky. That is how people get into a lot of debt on Robinhood, is selling calls that they don't have the 100 shares to protect and sell if they do get that call that they're selling exercised. Okay, so that's the idea behind covered calls, right? You own 100 shares of that underlying stock, in this example, Apple, and then you're selling calls against those 100 shares to collect premium, either weekly or every other week or even monthly. Now, remember, the more time that there is until expiration for that call that you're selling, the greater chance that it might hit that strike price and you may get your option exercised, in which case you'll lose those 100 shares. But today we're going to talk about the poor man's covered call. The poor man's covered call is essentially the same thing as doing a covered call and then selling a call against those 100 shares, but you don't own the 100 shares of stock. Instead, you're going to buy a long call, right? Typically anywhere between 3 to 6 to 9 months out for a strike price that's already in the money. And you're going to buy that call. So now you actually own a contract of 100 shares that you can sell a call against. Okay, so as the first part of this example for the poor man's covered call, we're going to talk about the long leg, buying a call, which is called our long call. We're going to go into Robinhood. We're going to use Apple as our example. We're going to click Trade Apple Options. And then we want to make sure that it says Buy Call. And as far as selling the calls, which we'll talk about, the second leg in a little bit, we want to make sure that there's weekly contracts available, right? So we can sell weeklies against this long leg, which will be our short legs. I want to make sure that my long leg is going to be at least 3 months out so that it has enough time to try to get close to that break-even price and be profitable for me. So this June 18th date is about 6 months out, which is perfect. I also want to make sure that my strike price for the long leg is going to be in the money. So I want to try to find a strike price that's going to be around 70 delta. Well, that was kind of lucky. So here the strike price of 117.50 has a delta of about 71. And what that means is there's about a 71% chance that this option will be in the money or break even by this expiration date. So right now it's 131 as a current stock price, and it says that there's a 71% chance that it'll be 138.05 by the time June 18th rolls around. I also want to make sure that there's a good volume, so 55 is pretty good. What's really great is there's about 9,000 open interest right now, so it's going to have a lot of volume to it. And then we can add this as our long leg in Robinhood. Okay, so we've walked through buying our long leg, which is buying the call at least 3 months out. We did 6 months for Apple. And as you can see, I have the current trading price at 131.03. We are going to buy the strike price of 117.50. It had at least 70 delta. It had some pretty good volume to it. It was at least 3 months out. And it was also in the money. And then the premium for that was $20.55 per share times 100 shares. You have $2,055. Now again, if we had decided to purchase the 100 shares of Apple to do a covered call, that would have cost us $13,103. So we're essentially saving about $11,000 that we don't necessarily have, which is why we're doing a poor man's covered call, in buying a long leg instead of buying the 100 shares of the underlying straight out. So now let's talk about the short leg, which is actually selling calls against the long leg call that we purchased. And the idea behind selling the calls is to sell enough weeklies or bi-weekly calls to collect premium that then reduces this premium that we paid for on the long leg. So essentially what we're trying to do is, as the long leg increases in value as the stock goes up, again, you want to make sure that you're bullish on the stock. As the stock price goes up and that premium gets reduced by the amount that your long leg is profiting, but it's also going to be reduced by the amount of premium you're going to collect by selling calls against that long leg. So let's go into the example of that. Okay, so we still have our long leg here in our order, and now we want to go to sell a call, and then we're going to go all the way back, and today's the 13th, but you'll get the idea. Let me just jump to the 22nd. So for the short leg, you want to find an option that's out of the money, right? And you want to find one that you think has a pretty good chance of not becoming in the money. So the good way to do that is finding a delta around 20. There we go. So this $137 strike price has a delta of around 20%, 21%. So what this is basically saying is the delta loosely correlates to the percent of success. So here you can see 21 is the delta, the chance of profit, which means the chance of this stock, Apple, not getting to 137.87, the break-even price, by January 22nd, which is about a week away, is about 83%. So which means there's about a 17 to 18% chance that it might actually hit 137. But in that case, you can close this call that you're selling early and collect whatever premium is left. But the idea here, right, is this has a premium of 87 cents, which times 100 shares is going to be $87. Again, you want to make sure that your volume is high. You want to make sure that this is a stock that you're bullish on, and you want to sell this call. So now you're going to collect, and this premium is going to be instantaneous, right? Remember, once you collect premium, it's instantaneous in your account. So $87 you're going to get credited back into your account once you've made this purchase here of the buy. So let's go back and take a look at what that looks like. Okay, so now we're actually going to show you the example that we just looked at in where we're selling a call, which is the short leg of this poor man's covered call. So we're going to sell a call at a $137 strike price. The premium that we're going to collect is 87 cents per 100 shares for $87. So now if we take a look at this $2,055 that we've paid to own that long leg, the call that we bought, now we can actually add in the $87 premium that we just purchased, and we're going to get 1968. And the idea here, right, is sell enough covered calls, sell enough calls against this long leg to reduce this premium that we paid for the long leg as the long leg also increases in value. So just to summarize this poor man's covered call, right? So there's two aspects to this. There's the long leg, right, which is you're buying a call. You want to make sure that that call is going to be at least 3 months out in expiration. You want to make sure that the strike price is in the money. You want to make sure that it has a delta of at least 70 or more. You want to be bullish on the underlying stock of that call. You want to make sure that it offers weeklies so that you can sell those calls against that long leg. And you want to make sure that it has high volume as part of the call and the option that you're going to buy. For the short leg, you're selling a call against that long leg. Again, you want to make sure that you're doing it weekly or every other week, bi-weeklies, selling those calls to collect that premium. You want to make sure the strike price of that call that you're selling is out of the money. You want to make sure that it has a delta of 30 or less. A safe bet would be 20. You want to make sure, again, that also has high volume. And then your goal should be 50% of that premium. So once that call reaches 50% of the premium, as theta is decaying that week, you want to probably buy that call option back and collect 50% of that premium. Just one other thing to consider is if you're selling a call, weekly call, bi-weekly call, and the price of the stock actually starts to go up and the strike price or the option that you're selling becomes closer to being in the money or at the money, you may want to try to either buy that contract back and cut your loss if there is a loss, or buy it out and sell another one that's further out in expiration and up in strike price. So if your strike price was $1 that you were selling and that stock tries to get closer to $1 and it's got maybe a week left, maybe close that one and sell another one a week further out and maybe $2 or $3 as a strike price. Again, I hope this video has been helpful explaining the poor man's covered call and went over a little bit of what a covered call is. If you have any other questions, please feel free to leave them in the comments below. If you could also make sure that you subscribe to this channel, like this video, like the other videos that I have that I've offered as well in this channel. Again, if you'd like to support this channel, I will have links below to help support me by using my referral link for Robinhood as well as my Venmo account. And again, please let your friends know about this channel, help share it on social media. And again, happy trading. We'll see you next time.